listening to some of those CEOs, they're not too happy with this idea about these reserves. Are they right? Is it really going to suppress lending? Is it really going to hurt the economy?
Well, listen, of course, the bank CEOs are not going to be looking for higher capital levels. I think the banks are doing pretty well right now. You know, the mantra that I used in 2008, David, was kind of how do we keep banks safe and sound while also driving jobs and economic growth? And it would be hard to say that we're not doing a pretty good job on both of those right now. I think the banks are safer and sounder than they've been since 2008. And I think, on the other hand, people are pretty pleased with economic growth, really pleased with job creation in the U.S. So I think one of the things they're saying is there's some balance. Factually, if you raise those capital levels, they are going to have lower ROE. And factually, there'll be less capital for lending. So I think what they said is correct. I think the balance you have to put it is one of safety and soundness.
Well, and safety and soundness, has it gotten more important to make sure that these really big banks, the really big money center banks, are safe? Because there was a time we said we don't want to have too big to fail. I think we're past that point. At least with that handful of big banks, I'm not sure we can handle if they fail.
Well, I think that's a very good point. And if you go back to 2008, both Citi and Bank of America, two of the biggest four banks in the U.S., were pretty much insolvent without the TARP program. So the Fed and the Treasury came up with a program to put equity in the banks, and they're doing great today. But the truth is, the big four banks, JP Morgan, B of A, Wells Fargo, Citi, today versus 2008 are bigger, more concentrated, closer to government, more like utilities or an oligopoly at that level. And so if there was a mistake, if there was a systemic failure, it would be a problem.
Well, talk about the banking system overall. Are we headed toward a world where we really have a handful of mega banks and then presumably a lot of small community banks to handle local things, and we really are putting a lot of pressure on the middle, the so-called regional banks?
Well, this is why we have been talking so much in Atlas Merchant Capital about the opportunities in regional community specialist banking. You know, we have over 4,000 banks in this country. We're very, very unique in that way. And I think the benefit that has to our economy, the diversification of lending, particularly the lending to specialist companies, middle market companies, but we also have a very diverse financial services industry outside of the banks. So, you know, we own three middle market M&A advisory platforms, or advisory platforms for middle market companies in the U.S. They serve small businesses and family-owned businesses in a way that the large mega banks just can't afford to serve them. And all of that benefits the financial services industry. So we're very positive on the regional banks and the community banks, and we think that there's clearly a spot for them.
The regional banks in 2023 have come under a lot of stress. Starting with SVB, we had those failures. There was a lot of concern about them. They're caught in between. And they have a lot of the costs, particularly regulatory and other costs, that the huge banks have, but they can't distribute it quite as broadly. Should we be promoting, encouraging, allowing more consolidation at that rank?
I think it's going to happen fairly naturally. And, you know, to your point, David, they got hit with, you know, a triple whammy with interest rates moving up quickly. The mark-to-market portfolio or the Treasury portfolio that was not mark-to-market got hit for every bank. I think loans as a percentage of assets are higher in regional and community banks, and so there's been some concern there. And lastly, and I think it's not really a topic as much as it should be, is the higher regulatory costs. And post-SVB and First Republic, the impact of regulation and inspection on the smaller community banks is just much greater than it would be on the larger banks.
As you say, Bob, there's increased regulatory costs, and those get distributed. They don't ramp up or ramp down. They're not scalable. But what about tech costs as well? We're on the edge of AI, generative AI, and how that's going to probably transform banking. Again, that's one thing for a Citi or a Bank of America or a JP Morgan to afford it. It's another thing for some of these smaller banks to afford it.
I think it's going to be a huge advantage for them.
Oh, really?
I think the technology of processing and back office, and those are big challenges for the smaller banks. But I think their access to AI, will be a huge boost for them. So I think one of the things that we're pretty excited about going forward is that that'll be a pretty positive impact. But back to your point, David, 4,000 banks today. Some of the smaller ones are really good banks, but they're struggling to get their return on equity up. So we think some of the stronger ones are ripe for investment, and that investment can be to help increase capital levels, but can also be to give them the capital to acquire some of the smaller banks.
Bob, one more point about those hearings. We heard a fair amount of concern expressed by the CEOs that as you increase some of the regulatory requirements, you're driving money out of the regulated banking system, you're driving into private credit, into some of the non-bank banks. Is that a real issue? Is it a real problem? Should we be concerned about it?
Of course you want to be concerned about everything in financial services, but I think one of the great attributes of the financial services industry in the U.S. and its impact on the economy is the diversification. So the amount of private credit is actually quite a small percentage relative to all credit from the banking system. But it's venture funds, it's hedge funds, it's credit opportunity funds, it's regional banks, it's community banks, it's M&A advisory platforms for middle market companies. No other country has as diverse and strong and diversified financial services industry as we have. I think it's one of our great strengths. So does it need to be regulated? Of course. But is it a real positive for our economy that not all of this activity is happening in 4 banks as it is in Canada and many of the European countries? I think it's a real positive.
But taking the point of view of the large banks just for a moment here, is there a risk of the private credit facilities cherry picking? It may not be big in the overall course of things, but they make it the most lucrative.
It's competition. I think it's fantastic. Of course, the private credit platforms are going to look for the best pieces of the lending sector. So I think that competition will be very good.
Is there systemic risk is the big issue from a regulatory point, and that's what we really care about is the overall system. Is there systemic risk because we don't really know what's in a lot of the private credit?
Listen, one of the things that it's been hard for anyone to think about since 2008 is that failure is okay. Too big to fail is talking about systemic risk for the economy. So many of these private credit platforms have sovereign wealth funds investing in them. So the risk is well diversified. And I think if the Fed and the Treasury felt that there was systemic risk on the private capital platforms, they should take action. But I don't see any evidence that failure in private credit right now is going to create systemic risk.
Historically, private credit was available to sort of the more wealthy, the more sophisticated investors of various sorts. But we've seen, certainly in private equity, a move into retail, ways of figuring out retail to participate.
Yeah.
Is that happening in private credit, and does that pose a risk for just a mom and pop putting their money, their savings into this?
I'm not as close to some of the private equity firms, but I would expect they're looking more and more at retail as well. Again, it's the diversification, and it's the question of is there systemic risk?
So to make the banking system even stronger than it is today, you said it's pretty good shape. What would you do?
Well, listen, I think what Michael Barr is looking at as the vice chair in terms of the capital levels is appropriate given that the banks are larger, more concentrated, and carry a larger and larger percentage of the deposits. So at some point, you and I have talked about this, is it 4 large banks at the expense of a couple thousand banks? I'd like to see the capital levels a little bit less onerous at the smaller community banks and the regulatory costs a little bit less onerous there, and give them a chance to continue to grow and get their ROE up.